This is the October 2023 Argent Wealth Management Market View. My name is Matt Restuccia. I'm the Chief Investment Officer and a Principal at Argent Wealth Management. At Argent, differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof, helping to simplify your life. Connect with us on social media at Argent Wealth and Argent Wealth Management on LinkedIn, Instagram, Facebook, X, and YouTube. So let's start with the conclusion. Uncertainty over the future of inflation and Fed policy may keep investors on edge and markets volatile. Inflation could continue to trend down while the economy stays strong. Many people are not forecasting that. It is possible. The consumer is strong and can handle higher rates, and the odds of a recession are low. For the above reasons, it's unlikely we are headed for another bear market. It is more likely the uptrend that started in October 2022 resumes. You can see the employment situation. There remain 1.5 times the amount of job openings per unemployed in the US. There is more demand than supply of labor. Although that's at 1.5 times, it has been trending down. It was 1.2 times, and that's bringing wages down with it. Again, it is possible to keep the economy strong with inflation trending down. In addition to strong employment conditions, the availability of credit to consumers and businesses is improving. That is typically something you'd see getting worse before a recession, and the fact that it's improving means a recession is unlikely. Moreover, consumption is about 70% of GDP in the US, and the US consumer has had higher than normal excess savings. A major reason was the extraordinary stimulus during COVID, but after-tax disposable income remains robust and is generally increasing. Confirming consumer strength, the financial obligations ratio remains low. This takes things like vehicle leases, rent, insurance, property taxes, and debt payments and divides it by income. It is below or right around 14.5%. Historically, the average is 16.09%. And you can see that before recession of 2008 and 2000, that ratio got up towards 18%. So we are nowhere near that. Due to the previous slides I've highlighted, it's no surprise that recession odds continue to trend down here. This is a Ned Davis model, and you can see when recession odds are below 30, the market tends to do well, up 9.35% per annum. The yield curve has been concerning. Typically, an inverted yield curve has portended a recession. The yield curve, though, this blue line, you can see where yields have increased and it has become less inverted. That reflects lower odds of a recession. It also reflects inflation expectations. A less inverted yield curve with higher rates may be reflecting investors' expectations that a robust economy is the very thing that could keep inflation higher for longer. So although it's possible inflation could come down while the economy stays strong, it's also possible that the economy staying strong could keep inflation higher, and that's the uncertainty we're really facing here, and that's why stocks have been volatile, because higher inflation would keep the federal funds rate and the Fed higher for longer, and that would potentially have a negative impact on the economy if the Fed were to raise rates too high. So if we look at the Federal Reserve, since it's uncertain how fast inflation will continue to decline and the economy remains strong despite the fastest tightening cycle in history, investors have priced in greater odds the Fed raises their federal funds rate again and keeps it higher for longer. You can see here the current expectations are 5.25 to 5 for March 2024, but you can see blue here, the increased expectations versus 1 month ago and 3 months ago. Expectations are increasing that there could be an additional hike in the federal funds rate and the federal funds rate is going to stay higher for longer. Now, if you look at Ned Davis's inflation model, which consists of 22 indicators that primarily measure the various rates of change, like commodity prices, consumer prices, producer prices, and industrial production, it is still in the disinflation zone where inflation decreases by 1 percentage point per annum. So if inflation did drop 1 percentage point, it would bring it to a healthy level. You look at the all items inflation right now is 3.71, 1 more percent, you're at 2.71. Core inflation at 3.4. You can look at history. Both those readings are well within the norm of history over the last 20 years. So, and also given the economic data, one could argue that even if the Fed does raise rates one more time to lower inflation, the economy is in good enough shape to withstand that increase. And if that helps bring inflation down a little bit faster, why is that so bad? So are we in a bull market still? You can see the Russell 3000, which represents the total stock market. It's been in a bull market since October 2022. It did peak in the late summer, and it failed to reach all-time high set at the end of 2021, and it has been in a downtrend here for the last 3 months, which has a lot to do with the uncertainty we've been discussing around inflation and Fed policy. But it seems like to me investor sentiment, as shown here by the Ned Davis trading sentiment poll, is getting pretty pessimistic. Again, economic indicators are strong. Consumer is strong. Can probably withstand another increase in rates. Inflation is trending down, although it's uncertain how fast it will trend down. But you can see people are getting pretty pessimistic, and that's followed along with the market going down. But you can see when investors are pessimistic, the market tends to do best. When it's below 41.5 on this chart here on the bottom clip, returns are 26.57% per annum through the history of this chart. So if the odds are that a recession is low and inflation's on a downward trajectory, so it's unlikely we're headed for a bear market, it makes sense that the bull market that started in October is likely to resume at some point. And if you look at the history of bull markets, the average is an 85.9% gain over 576 market days. We're only up about 20% over 250 days. So if we do re-enter a bull market, investors can expect more returns in the future. Thank you for listening. If you want to learn more about Argent, visit our website, argentwm.com. You can reach out to us at contact@argentwm.com. We run a value strategy stocks. We run a hedge fund with stocks, long, short. We run global asset allocation models with ETFs. We also run a mutual fund version. We run a high dividend stock strategy, a growth or innovation strategy, and we do private equity and private real estate. We've been doing it for a long time.